The introduction to Nadex knockouts and call spreads webinar. I'm Adam McCaden. I will be leading you on this about hour journey today through our contracts. So without further ado, I think we're about a minute of past due to start. So let's jump right in, get all the house cleaning out of the way first, and then we can get into the nitty gritty. Yeah, again, this is going to be the Nadex knockouts and call spreads. We're going to be going over the basics. But first, before we do that, we always have to look at this nice, beautiful disclaimer here. We always have to look at it before every webinar we do. Very basically, what this webinar said, what this disclaimer says is that any trading on Nadex and any trading really anywhere that you trade, it's going to involve risk. Any money that you put into any trading product, you should be aware that you can lose that money potentially. So you want to trade with money that you can afford to lose. You don't want to trade with money that you need to pay rent, for example. The other thing is I will be placing some trades on the demo environment today to show you how to actually functionally trade the call spread and the knockout products. None of the trades I'm going to be placing are any kind of recommendation to go ahead and make those trades. They will just be for the purposes of showing you the functionality, and I'm not going to be picking them as if they are actually good positions to enter into. So I'll let this sit up here for one more second. If you do have any questions throughout the webinar, throw them up in the chat, or if we, I think last week we had some technical difficulties, and everyone here helped me out with that. So if you can't hear me or can't see me or can't see the screen, just throw it in chat, and we'll deal with it as it comes. All right, I think that's long enough on the screen there. We'll go over to this next slide, and you're probably seeing two of me now. Just a little bit about my background. I've been working at Nadex since 2017, so about 5 years now. And the last 4 of those years, we've been focusing heavily on our products and on our platform. So that's why I like to do these webinars. Was around when we were talking about how to create a lot of these products. So I like giving kind of a background and an overview on how to trade them. And then in my personal life, I started trading, this was 12, it's probably almost 13 years ago now. I'm probably aging myself, but as soon as I was, of age to trade, I've been trading, and mostly equity options. So that's primarily what I trade, and we'll get off this page so you don't have to look at my face anymore. And we can actually get into the nitty gritty of the part that y'all are all here for, the actual knockouts and call spreads. So quick agenda. We're going to go over knockouts, how they work. We're going to go over the risk and the reward and all the capital requirements of them. And then we're also going to go over call spreads. And hopefully that should only take about half an hour. And then I do want to jump into the Nadex platform and actually go over places with those trades, show you how those trades work in an actual trading environment, in the demo environment, that is. So what are knockouts? We'll jump right in. Knockouts. Basically, a knockout contract is going to be a contract that trades within a set price range. There's going to be 2 sort of barriers on the knockout, an upward and downward one. The one on top is going to be called the ceiling. The one on bottom is going to be called the floor. Your trade is going to exist between these floor and ceiling levels. Every knockout contract is going to have a floor and a ceiling. And every call spread contract will have that too. And you'll notice as we go through this webinar, as we talk about this, the knockouts and the call spreads are fairly similar. But there are some major differences as well that we'll get to. So when you are between that floor and ceiling range of the contract, generally the value of the contract is going to move in line with the underlying market. It's not always going to be exactly 1-to-1, but generally it's pretty much going to be 1-to-1 movement with that underlying market when it's inside the floor and the ceiling ranges. And really the same as any other contract, or same as trading the spot market, same as trading the futures market. If generally you think the market is going to go in an upward direction, you want to buy. If you think it's going to go in the downward direction, you want to sell. Like all Nadex products, you can get on both, the buy, the long side if you think it's going to go up, or you can, if you have you're of the opinion that it's going to go in a downward direction, you can always sell or short the underlying market. So basically, there's 2 ways that your contract can actually expire, right? So there's 2 ways that you can actually get triggered, get out of the contract. The first way is going to be the price triggered settlement, and I would probably say about 95% of cases, this is going to be how your knockout contract is settled. It's going to be price triggered. What does price triggered settlement mean? Well, basically, it just means if if it hits or goes through, goes above that ceiling level, or if it hits or goes below that floor level, the contract will expire at that point, right? So basically we have a floor ceiling, we're going to move one-to-one with, we're inside of this, but if we hit that ceiling, we hit that floor, you're going to get knocked out, as we call it, knockout contracts, and your contract will expire at that point. The other way that these can settle is going to be called a time triggered settlement. And very basically that is if the contract trades within that floor and ceiling level for the entirety of the contract and it doesn't hit either of them. So all of our contracts, all the knockout contracts are weekly contracts on the exchange at this time. And so they all expire at differing times on Friday afternoon. But very basically, if you get into a contract, let's say Wednesday, and you have your floor and the ceiling, it just trades in between them all the way until Friday at 3 or so, well, it is going to trigger at Friday, even if it doesn't hit the top or the bottom. It's just going to settle by time. And we'll go over how kind of both the settlements look in just a second as well. As we just talked about, each knockout does have a duration of 1 week. So most of them do open up on Sunday evening, some of them open up Monday morning, depending on the underlying market, and then almost all of them close Friday afternoon, whether that be, I think it's generally around 3:30 for the 3:30 for the commodity contracts, around 4:15 Eastern for the indice contracts, and around 4 for the FX contracts. So at the beginning of the week, for every single underlying market, Nadex lists 4 knockout contracts, right? So we'll see a little bit in a couple slides kind of how, but they're a little bit overlapped on each other. And very basically, the market's always going to be within those 4 contracts. When one of those knockouts gets knocked out, right? When the underlying market hits either the floor or the ceiling, the contract knocks out, immediately, Nadex will automatically list another knockout contract. Right, so you have the top one, it goes up and knocks out. Immediately, there will be another contract listed. So there should always be, instead of, except for in very, very rare scenarios, there should almost always be 4 knockouts trading from for each underlying market. And that really just gives you the ability to, pick your entry points really well. Pick the points where you want to get in. If a lot of times if you're selling a contract, it might be a little bit better to get in closer to the ceiling. A lot of times if you're buying a contract, it might be a little bit better to get closer to the floor. And again, we'll go over why that is when we talk about how these are priced and sort of payouts for those contracts as well. And so here we have just kind of an example, and I think this will, if anyone's not following so far, I think this might illuminate it a little bit more. So here are 4 knockouts. So let's say this is the beginning of the week. We have gold, it's trading at 1820. And we have these 4 knockouts right here. And so here we have our 1820 point. As you can see, they're kind of staggered, right? So when they're listed, you have your different points here. These are all 50-point ranges for gold. They're $500 contracts, so each tick is a 0.1. We'll get into that in a little bit later as well. But all you really need to know for this slide is very basically, there's the underlying market, and these knockouts are listed. They'll be 10 points below the market to 40 points above, and sort of staggered down from there, right? So you always have these 4 knockouts, and as you go on, as you start trading them, let's say in a scenario, let's say gold actually moved up to this point, right? So you're trading it, gold moves up to this point, and it knocks out this knockout number 4 down here. So immediately this knockout number 4 disappears. Anyone trading that, if you were trading that, it will settle at that point, and you would either get your $0 payout if you're on the sell side of that contract, or a $500 payout if you're on the buy side, and then another contract would be listed almost immediately. Right? You have this new knockout contract listed immediately after the previous one. So you again always do have those 4 sitting out there, kind of giving you the availability to choose where you actually want to get in to these 4 knockout contracts. Excuse me, I'm going to just got a little bit of allergies today, so bear with me if I need to go blow my nose. Again, this is just sort of another real quick example. So on the downside, this is a scenario where you can kind of see if this knockout were to knock out, right? If it hit this bottom period, this new knockout again would be listed at the bottom. So there's a couple more ways to show how that price triggered settlement works, and how another relisting of that contract works as well as soon as it is triggered. So we just kind of went over the price triggered settlement. The time triggered settlement is very similar. Now, what is interesting? So with the price triggered settlement, if you are a buyer or seller in that, you will be getting the full amount of the contract, right? Because if you actually hit the ceiling, the buy side is going to get the entirety of the contract, and the sell side as a payout, right? Not necessarily profit, but as a payout. And the sell side is going to get a $0 contract. Same thing if you hit the floor of the contract, the sell side of the contract is going to get sort of the entirety of the value of the contract, and the buy side is going to be get a $0 payout. So at expiration, if they are triggered by hitting the floor or ceiling, it's going to be sort of an all or nothing proposition in terms of your payout. However, if they trigger from time settlement, it's a little bit more variable, what we call variable payout. So when they are triggered via time settlement, or this is also sort of true if you actually exit your contracts early, which we will also get into a little bit later, your payout is going to be relative, basically where the market is to either the floor or ceiling, right? So if if you're on the buy side, your payout for a contract that is triggered by time is going to be where the market expired, right? So let's say in that last example, gold was at, I don't know, at 1800. Let's say our 1820. Let's say our contract is trading 1800 to 1850, right? Just real quick math. We get it at 1820 and it expires at 1830. Our payout there is going to be 300, basically 30 minus the 1830 minus 1800 gives you that 30, and then you have the 0.1 tick. Again, we will go, I know this is, I'm kind of just explaining this out of hand here. We will go into this in a little bit more in detailed examples when we get to the platform. But what you really need to know right now is when that time is triggered, the time triggered settlement, the payout is going to be basically based on where the underlying market is sitting, not based necessarily on hitting that floor or ceiling level. So again, we kind of just see here, this would be a scenario where, we had gold trading the beginning of the week when we were back here, it trades all week, and then now all 4 of these knockouts would be knocked out via price settlement. And basically, if I was the buy side, my profit or my payout would be the difference between the floor and the actual price that it settled at. We will jump into that as well, and I am going to get into the nitty gritty of all the numbers here to fully explain, how much these cost, how much you're going to pay to get in, how much you get when you get out, what your profits, what your losses can be as well. So don't worry. I just want to make sure that we're all on the same page on how they functionally work first. So the knockouts are pretty nice in that, like all Nadex contracts, you do know your risk and reward up front. So all Nadex contracts, they are fully collateralized, and they are, what you can't lose more than what you pay to get in, and your maximum risk is always going to be what you actually pay to get into the contract. You also sort of have a built-in stop loss and a built-in take profit level. You're never going to get sort of blown through your stop loss, right? Because functionally the contracts can't do that. They can't go below their stop loss and they can't go above their profit target. So people, if you traded elsewhere and you traded with stop losses in the past, you may have experienced a situation where a precipitous drop in a market can actually blow through your stop losses, right? It can actually go, the market can be moving so quickly that you don't get filled on your stop loss level. This can happen in other markets. It cannot happen at Nadex. It cannot happen in a knockout contract purely because the floor level, the contract basically does not exist below that floor level or above that ceiling level. So you're always going to get triggered on the bottom or on the top, depending on, if you're buy or sell, that'll be your take profit or your stop loss levels. So on the buyer side, your maximum risk is going to be the difference between what you're paying to get into the contract, the buy side price, and the floor of that contract, right? So in the example we were looking at earlier, we have an example where gold is trading from 1800 to 1850. Gold is at 1820 right now. Your maximum risk on that contract is going to be 1820 minus 1800, right, as the buyer, because that's where the market is versus where the floor is. That's going to be 20. you need to take that tick count into a size, which is 0.1, so that's actually a 200 maximum risk. But very, very basically, on the buy side, what you're paying to get into the contract, and therefore your maximum risk, is going to be where the market is minus the floor price. On the sell side, it's going to be the exact opposite, right? It's going to be where the ceiling is minus where the market is, right? Because on the sell side, basically, if you want to think about it, if you kind of break it down, and we'll look at it like this, but if you think about it kind of as a whole pie, and here's where the market is on the buy side, this is the section you're paying for. On the sell side, this is the section you're paying for. And then on the reward side, it's the exact opposite, right? On the reward side, the buyer's potential maximum reward is going to be the difference between the ceiling and where the current market is, right? Because if you get in at the current market price and it moves all the way up to the ceiling, that's very good for you as a buyer. That's going to be your maximum reward, and that actual profit is going to be the ceiling minus where you entered the market. And again, on the sell side, it's the exact opposite, right? So the sell side, you want the market to move in a downward direction. Therefore, your maximum potential profit on any contract you're getting into a sell side is going to be where the market is minus the floor, right? Because your maximum profit is if the sell side goes all the way down and hits the floor of the contract. So we have another sort of example here with the risk and reward, and we were sort of just going over it, right? So if this is a contract, we have this knockout 2 here. If it's 1800 to 1850 and gold's trading at 1820, on the buy side, you have sort of a 20 point here. And actually, I think the next slide, yeah, here we go. This is a lot better than me just sort of explaining it out of hand here. So this would be, so we just go back. So we're going to look at this knockout 1, right? So this example we've been going through the whole time. We're gonna kind of dive a little bit deeper into this. So if I was on the buy side here, right, I'm getting in, gold's trading right now at 1820. The floor is 1810, the ceiling is 1860. And for this example, we're not going to go into the whole tick size thing. We'll do that in a second. Just for this one, we're going to keep it super clean numbers. And we're going to say, okay, if I'm getting in on the buy side, what I'm going to pay is $10, right? Because actually 100, but what I'm going to pay in this example, if we're not looking at the tick size, would be a 10, right? Because 1820 minus 1810, that's 10. And my potential reward is going to be 40, right? 1860 minus 1820. Because what I want on the buy side is for this to go in an upward direction. Because all the way in an upward direction, I get my maximum payout. I don't really want it to go against me, but if it does go against me, my losses are limited. They're stopped at that floor level, right? And so we can do sort of the same thing with the sell side contract. And what I do like to show here, and why I'm sort of showing, with the buy side, we showed the first knockout. With the sell side, we're showing the fourth knockout, is because it's fairly realistic to how you might want to trade these. The reason being is if you get into a sell side contract, if I get into this one here, I have a lot more room for the market to go in a downward direction, and I have a lot less room for it to go in an upward direction, right? I have a lot less risk here for it to go and move against me. I have a lot more for it to go in the other direction. This floor should definitely say 1780 and not 1880. But very similar to what we were talking about with the buy side. So just not even taking any of the sort of the tick levels into account. Let's just say that in this kind of scenario, it's not actually this, but let's say that if we got into 1820, the ceiling's at 1830, we would pay 10, right? 1830 minus 1820. We're paying basically this level if we're on the sell and we want it to go in a downward direction. Our maximum profit here is going to be, if this goes all the way down to the bottom, so 1820 minus 1780, which is what it should be, that's going to be 40 for your maximum profit. And so you can see in both of these examples, you sort of have the same risk reward proposition, whether you want to be on the buy side or the sell side. And that's because there are 4 different knockouts that you can trade at any time. So we will go, when we get into the platform, I will really deep dive and excuse me, we'll really deep dive into the exact calculation of how you calculate what you're actually getting in, what your maximum potential profit. So in terms of capital requirements, you always know your maximum risk before the trade is placed. So we talked about that a little bit earlier, not only with knockouts, but with old Nadex contracts, you're gonna know your maximum risk before you get into the trade. and your maximum, what you're actually placing into the contract, or your capital requirement basically to enter the contract, that's going to equal your maximum risk. So whatever you put into the contract, right? In our previous example, if I put in $10 into a contract, that's what I'm risking. I'm risking that $10. I can't lose more than that $10. There are no margin calls at Nadex, right? These are unmargined products, so you can't lose more than what you actually pay to get in, which can be a consideration for trading on other sort of products elsewhere, but not at Nadex. Buying, selling, doesn't matter. You're not going to lose more than what you pay to get in, and it's going to be fully collateralized contract. So we'll go over call spreads here. So that was kind of a quick run through in knockouts, how they work, what they are. Call spreads are very similar to knockouts, and you'll notice immediately from this slide that you'll see, okay, this is another product that trades between a range. It's got a floor, it's got a ceiling, right? So really, we're looking almost the exact same, right? We have a floor level up here, down here. We have a ceiling level up here. How are the call spreads actually different? Well, one of the reasons is that the call spreads don't actually move as close to 1-to-1 with the underlying market as the knockouts do. This is because, and I'll show you on the next slide here, because even though you have that floor and the ceiling level with the call spreads, the very major difference between the knockouts and the call spreads do not expire if they hit the floor, if they hit the ceiling, or go above the floor or go to the ceiling, right? They can only expire through that time triggered settlement that we talked about with the knockouts. There is no price triggered settlement. So, excuse me. So what this does basically, and why we were talking about how these call spreads don't actually move 1-to-1 with the underlying market like the knockouts tend to do, is because these don't expire at the floor and don't expire at the ceiling levels. There's a lot more time value baked into the contract. There's a lot more volatility baked into the contract, right? The volatility of the underlying market and the time value left in the contract is going to matter a lot more with the call spread contracts than it does in the knockout. And I'll sort of explain why that is, because I think it can be a little bit confusing. But if you really get down into it, it actually makes sense why the call spreads, because they don't knock out at the top and bottom, why they don't actually move 1-to-1, and why there's a lot more of this, what we call optionality, baked into the contract. Okay, so we have something here. When trading knockouts or call spreads, I'll actually go back here. So when trading knockouts and call spreads, you can actually exit early. So you don't actually have to stay into the expiration of the contract. But before I do jump over, because after this we are going to jump into the platform here and do some actual trades inside of the platform itself. But I do want to actually touch a little bit more on this call spread and the concept of optionality, because I think it is a little bit advanced, but I think everyone here can get it. So very basically, the call spread, because they don't knock out when it hits the top and the bottom, you basically have time to be correct, right? So we could go back to the example we did earlier with gold, where it was 1810 to 1860. In the example of the knockouts, if I buy a knockout contract and I end up being wrong, right? I buy it at 1820, it goes down to 1810. In the knockout example, I would have been knocked out of the contract. I would have lost my initial investment. However, with the call spreads, maybe I'm getting in on a Monday and the market immediately goes against me, right? I buy the contract, it goes down. Okay, what am I going to do here? Well, for a call spread contract, if it goes below that 810, you aren't knocked out. You're still in the contract. The contract, if it expires, is going to be worth 0, right? Because it's still, the payouts are still very similar, right? So if it expires below the floor and you bought, you're still not going to get a payout. However, because these only expire through the time triggered settlement, you actually have time to be correct, right? So you can actually sit in that call spread contract all week, and maybe Monday, Tuesday, Wednesday, it's still below that 1810 point, but on Thursday it comes back up, starts trading again into that range, and basically what you have therefore bought with that extra premium on top is the ability to be right, the chance for the market to go in your favor or to turn around, right? So that's sort of the difference between why the knockouts can kind of trade almost one-to-one with the underlying market is because they're very linear because you are knocked out at the top and the bottom, while with the call spread contracts, because they only expire at a certain time, you do have this extra sort of premium and this extra sort of optionality, basically because you are sort of quote unquote buying the extra time to potentially be correct in a trade. And again, I think when I jump into the actual platform here and go through some of these trades, it's going to be a little bit more clear what I'm talking about. So let's actually jump in now. I think I have my, let's move this in. There we go. We have our login screen here. I'm going to log into my demo account here. I like Nadex. This is my wonderful demo account. And we'll log in. If you are very new to the exchange, how you get to that login screen, that's our login screen. How you get there, you want to go to nadex.com. Login's going to be in the top right corner. But we are logged in now. We have our 3 different products, right? We have our binary options, our call spreads, and our knockouts. If you are interested in binary options, I did a webinar last week. You can go watch that on our YouTube channel, or I'll do another one in about 3 weeks. So check back for that. But for right now, we're going to focus on the call spreads and the knockout contract. So let's bring up a knockout first. We'll do an index. I think the indexes are generally a little bit easier to understand because a lot of them are just one-to-one movement. So you'll notice if I click my index, so we have indices, we have Forex, right? We have a bunch of different Forex contracts. We have a bunch of different commodity contracts as well: crude, gold, nat gas, silver. But for this, I click into the indices, and we have our 4 major US indices we can choose from. And then you'll see as I click on each individual one, we have our 4 different knockout contracts, right? As I mentioned earlier, there's always going to be 4 knockout contracts available. As one's knocked out, another one will be listed. And if we're lucky enough, maybe we'll see one of them get knocked out while we're talking here on the platform, so we can actually see that in action. So, and then we do just want to choose whichever contract you actually want to trade here. So we have our 4 different ones. And you'll also notice on the chart itself, as I'm selecting them, you can actually see the knockout ranges sort of overlaid as I move up and down. You can also choose them from the chart itself too. So right different knockout options here. And you'll notice as well, so on the top one, you'll always have one that's maybe a little bit more advantageous to trade as a buyer, and always one that's maybe a little bit more advantageous to trade as a seller. And what I mean by that is when you're getting into these contracts, there can be other strategies. Now, this isn't a hard and fast rule, but generally, if I'm getting into a sell side contract, I'm going to want to get into one that's probably trading a little bit closer to the ceiling, right? Because at this point, what I'm going to pay is this kind of range here, and what I'm going to potentially get in reward is this range. And similarly, conversely, if I wanted a buy side contract, I probably want to trade one where the underlying market is a little bit closer to the floor, because what I'm going to pay to get in is going to be this range, and what my potential reward is going to be sort of this range. So let's do a buy side contract just for this one, just real quick. So I'll click on kind of the blue here. You can select it many different places. And so we have our deal ticket now on the right hand side of the screen. The deal ticket's fairly self-explanatory, right? We have our name of our contract. We have our floor level here. So our floor level for this contract is 44.37, and our ceiling level is 44.87, right? And if you actually subtract that, that's going to be 50, right? 44.87 minus 44.37. It's a 50-point range. Now you may be saying, Adam, is this contract worth $50 overall? No, it's worth 500. And here is where we sort of get into the tick value discussion. So we'll see here. If I actually put, let's just put in a limit price, and let's do something nice round here. Okay, so we have 4447, right? So if we wanted to enter this contract, I've just selected this price. We can't actually probably buy it for this price yet. Actually, now it looks like we can. But if I wanted to enter the contract at this price, right, at the price of 4,447, you'll see what I'm paying, the difference between this and the floor, right? 4447 minus 4437, that's 10. But what I'm actually paying, we see our max loss here, and as we remember from earlier, our max loss is going to equal what we pay to get into the contract. We're seeing $100, right? Because how the US 500 works, and here we get the tick size, every 0.1 movement in the underlying market is going to be worth $1. on the Nadex knockout contract for this particular market. It is important that when you're trading these, you go ahead and you figure out what that tick size is, because it's not going to be the same for each market, right? For example, if we go down to, I believe if we go down to the Wall Street 30, we have $34,900, $35,400, and you'll notice if I get in here, let's say at 35,100, right? 35,100 minus 34,900, that's 200, right? So therefore we know I'm also paying 200 to get in here. We can see that. So you kind of know, okay, the Wall Street 30, if I'm trading this contract, $1 movement in the Wall Street 30 is going to be a $1 movement in the Nadex knockout contract. While again in the US 500, it's going to be a 0.1 movement in the S&P 500. It's going to be $1. So I just want to make sure that's very clear, because it is important to just check the tick values for these contracts. It's something you can figure out. It's also something, if you go to our contract specs pages on our site, they are all listed there. But it is fairly easy to figure out, especially for, I will tell you, all of these US index contracts are $500 ranges. So if you see, okay, this is a 50-point range, it's a $500 range, right? That means 0.1 equals $1 movement. Anyway, I think I've belabored that point for a while here. I just want to make sure that's all clear. But if we go back here, I'm going to type this in again. We see 4447. So 4447 to 4437, right? That's 10. That's going to be this sort of range here, and that's $100 to pay in. We also see our max profit here. Our max profit sitting there at $400, and we can say, okay, well the ceiling range here. So if we did 4487 minus 4447, that's going to be a 40. That's going to be a 40 points or 400.1 sort of movements, and that's why it is $400 max potential profit, right? So this is going to be $100. This is going to be $400 if it goes all the way up here. So I think I've talked about that quite a bit. Let's go ahead and actually get into this contract. So I'm going to switch this over to a market order so we can get in kind of quickly. We'll see I'm getting into the best available market price here. Place order, and there we go. We have our contract. It's we entered it here. I think our average price was 448.9. So we paid about $119 is what we paid to get into this contract at 448.90 cents. And it actually looks like it's already moving in our direction. So hey, looks like we actually made a correct pick. Generally, when I'm doing these on these webinars, they always seem to go against me. So I think we can pat ourselves on the back for this one. And it does seem to be going positive here. So I will go over sort of this panel here just super quickly. I think generally it's fairly simple, self-explanatory to look at a lot of these things. The one thing I do want to look at though is our profit and loss and how this average price and current price relates to the P&L, right? So I could with this contract just sit and wait, right? And one of two things is going to happen. Either, I guess maybe three things. So it might go up, and I might hit this 4487 level. If it hits that level, right, I paid $119 to get into the contract. My payout is going to be $500, right? So if it hits the ceiling, I'm on the buy side, my payout is going to be $500. My profit would be 500 minus 119, which is very quick math in the head, 381. So my profit on that would be 381 if it hits the very top, because 500 minus 119. If this second scenario goes all the way down and hits this 4437 price point, I'm going to get a $0 payout, and therefore my loss on the trade is going to be $119, right? So those are the two sort of all or nothing scenarios, right? If it goes all the way up, it's the ceiling, that's all or nothing one way, all the way down, it hits the floor, that's all or nothing the other way. And if I was on the sell side, those would be sort of reverse what I just talked about. Now, the third way that you can get out is if this actually just doesn't hit the floor or ceiling, or if you exit it early. Now, if you exit it early, the profit or loss you're going to receive is a little bit more variable, as we talked about. It's going to be basically the profit or loss is going to be where you entered the contract versus where you exited, right? So if I entered at, 448.9 and I exit at 445.1, That's about 22, I think it was before it just changed on me. We'll do kind of an easier one. We'll do 448.9 to 4450.9, right? That's a nice 20-point movement. If you subtract those, that means my profit will be $20 because it moved up 20 points, right? So that's going to be how you calculate your profit and loss. If you exit the contract early, or if the contract just expires at whatever point it's at, right? If it expires via, it gets all the way to Friday, 3:15 p.m. on Friday, sorry, 4:15 p.m. Eastern on Friday. We're in Central Time, I mess it up sometimes. 4:15 p.m. Eastern on Friday, it's going to expire at that point. Then it's just going to be where the current market is versus where I got in. That's going to be your profit, right? There's very basically, again, if let's say in this scenario, what do we have here? 4437. Let's say it expires on Friday at 4467, right? Basically, I would be getting a payout of $300. I paid $200 to get in, so my profit would be $100, right? And as we can see here, the other very important thing to know with knockouts specifically, and actually generally with all Nadex contracts, is that if you enter into a contract on the buy side, what you're going to pay to exit the contract is going to be the sell side, right? So, or sorry, that's what you're going to sell the contract at. And same thing if you enter into a contract on the sell side, when you exit, you want to be looking at that buy side price. So we can see here, the current market price it's quoting me is actually the sell side price. And that's because if I were to exit this contract right now, what I could do, the best available price the market is offering to me is this sell side price. And that's also where this profit and loss is coming from. So it's always important to remember. And if we do this math real quick, we have 448.9 minus 447.9 is what I just said. That's going to give us 10 points or a minus 10, a $10 loss on the trade. I do have a question that just came in as I was going through a lot of these, so I will answer this very quickly. It looks like the max loss and the max profit in the ticket area already take into account the points correct. Yes, I think you're asking the max profit and the max loss take into account kind of the tick values, and yes, they do, because sorry, allergy is really acting up. So yes, when you look at the max profit and the max loss, it is telling you fully that's the max profit, that's the max loss, right? Like in dollar terms. So it is taking into account the kind of tick value. You don't need to do that yourself if you're looking at the max loss and max profit. Because if I were to get in, let's say, again, we could do 44. I don't know what is it right now. Yeah, we can do 44.7.9 again, or just 44.7, right? If I were to get into this, right, 447 minus 4437, that's 10. But if you look at this, yes, it's $100 here, right? So it's already taking into account that that each tick is worth 0.1, right? Each tick is 0.1, therefore each 0.1 is worth $1. So if you ever want to come back, this should be kind of your point of truth, right? Your max loss is always going to be giving you kind of what you're paying to get into the contract. Especially if you have a limit selected. If you have market selected, it might be a little bit different just because of the tolerance ranges, but it is always going to be about what you're paying to get into the contract. So yeah, if you're ever confused, just turn your order type to limit and look at what the max loss says. That is what you'll be paying at any point to get into the contract. And you can always, it's pretty easy to change the price around, right? You can say, oh, if I were to get in at 4457, okay, we can see that I would be paying $200, right? Because this is going to be kind of a 200 point from 4457 down to 4437. So kind of a little tip and trick to always make sure that you are looking at the correct number there. So let's get into a sell side contract as well, just so we can sort of see these. So we were just looking at the buy side contract here, right? If we actually get into the sell side, so a lot of times when I'm trading these contracts on the demo account, I do like getting into the sell side contracts that are, as I spoke about before, a little bit closer to the ceiling, and the buy side contracts a little bit closer to the floor, right? And as we can actually see here, let's say if I was on the buy side of this contract, we'll show what happens if I'm not doing that. So if I were to buy this contract, right, I would still be paying the distance between the current market price, or whatever this market price is, and the floor price. As we can see right now, that's about $425. And my max profit is only still going to be this little window right here, right? If the market moves up to this point, that's going to be my max profit, but it's not a very, it can be depending on your strategy. There are some strategies that use this sort of trading, but if you're just doing a kind of a single leg knockout, it doesn't make a ton of sense to get into a contract that you're paying about $400 to get into, and you only get the profit if it actually runs up about 75 points, right? It is generally a little bit better to get into contracts that are priced at this point on the buy side, because you have a lot less. This is going to be what you're paying. You get this as a reward. And on the sell side, you want to get into ones where generally you want to get into the ones where the market's a little bit closer to the ceiling, and you have a lot more room to run down this way, because on the sell side, right, you want the market to go down, and so you want this to go down. So if we got in this sell side contract probably a little bit earlier today, about an hour before I started doing this webinar, we'd be pretty happy. I think all of our sell side contracts would have knocked out, because this market has been trending down fairly heavily. So let's look at the sell side contract though. So this one, right, we got to look at our ranges again. So we have our floor range at 4407 down here. You can look at it in the contract. You can also look at it down on the chart itself. So 4407 right here, and then we have our ceiling at 4,457 up here, right? And the market's still trading at the same point, right around 4,446. So let's do 4446. Or we can do 4447. There we go. Now we have it. Now we have that nice, easy 100, 400 kind of thing going here. So again, we have, if we were to get into this contract at the price of 4,447, what we'd be paying would be the difference between that and the ceiling, right? So 4457 minus 4447, that's going to be 10. And again, that comes out to $100, because what we're paying is this sort of range here, and our max profit would again be 400, right? Just like the last one, but in this scenario, we wanted to move in a downward direction. So we're getting into a knockout where the underlying market is closer to the ceiling and further from the floor, right? Because our profits happen when it moves towards the floor, our losses happen when it moves towards the ceiling on the sell side. And so very similarly, we can go and we can get into a contract again here, and now we are at a sell side, right? So now we have kind of the sell side on the downside of this knockout, and the buy side on the upside of the similar knockout, right? So we have these next two contracts. They'll sit out here. We can actually let these kind of play out for a little bit while we go through a couple other points on this. One other thing to notice though, so and this is a fairly important thing that we'll sort of contrast in 1 second. On all of the US 500 contracts, and in fact all of the contracts, if I open them up, you'll see that the buy and the sell are all priced basically the same, right? I mean, they're all pretty much exactly in line. There might be like a little bit tick difference, but very basically, no matter which of these contracts you choose to get into, the buy and the sell prices are the same, right? Because it's following that underlying market. There is going to be obviously, a little bit on the buy and a little bit on the sell away from the underlying market. That's spread. That's in all contracts, not only on Nadex, but anywhere you trade, you're going to have that bid offer spread. But very basically, they move one-to-one, and they kind of that midpoint of these is very basically always going to be, these are always going to be right around that midpoint, right? The midpoint's always going to be right around where the underlying market is. The buy and the sell are always going to be very close to that midpoint. We can contrast this by going and looking with the call spread. So let's go pull up call spread contracts on the US 500, right? Same exact market. We can go in call spreads. We have all of our all of our indices here. We can go to the US 500. Let's do one that ends at 415 today. So there are a little bit more, but we can already see, right? If you're looking at these numbers, these are all different pricing. None of these are the same, right? We go from 4495, 4481, 4469, 4458. These are all different prices. We're the same underlying market, and same on the sell side, right? Whereas, as we just saw, we can go back to the knockouts again. So we have all of these different pricing options here on the call spreads, we go back to the same exact underlying market in the knockouts. These are all the same. Here, they are all different. So what the hell's happening here, right? This is where we come into this sort of optionality that I was talking about earlier. And so if we actually look at this contract here, we can sort of see it gives a little bit clearer indication of why this might be happening, right? So when we looked at the knockouts, all of the knockouts were the underlying market was inside all of those knockout contracts, right? Because it has to be. If it goes below the floor, if it goes above the ceiling, they get knocked out, the contract's over, a new one lists. With the call spreads, we can see this is clearly not true because this was listed around 8 a.m. this morning. This market's moved heavily in the other direction. And so now this knockout contract, this range right here, this is still a viable trading contract. But the market is way outside of that range, right? And that's why you're sort of getting these points where it's not trading around where the underlying market is. So the underlying market's trading right around 4449. The buy side of this contract, however, is trading all the way at 4,495. Why is that, right? That seems kind of crazy. Well, it's because, first of all, it's got to sort of trade in between these two ranges, right? The very floor of this contract is 4495. So it can't really trade below that range, right? Because again, what you're paying to get into the contract is still the distance between the buy and the floor, just like with the call spreads. And this isn't actually, let's look at one of these that's a little bit further down. I might go to an FX contract here just to show this a little bit better, because if they're all outside, it's a little bit harder to actually look at what's going on here. But you can see as the contract gets a little bit closer, that as it gets a little bit closer to the actual price, that the buy and the sell prices are also getting closer to the underlying market price. Really quickly though, I'm going to go try to find a contract that hasn't had a massive downtick in the last few hours. So we can just look at it. Let's see. This is also, I think maybe all markets have moved down. Let's see if there's something that's been fairly flat. Maybe pound euro or euro yen possibly. Sorry, I know. Okay, here we go. This is a much more kind of flat, choppy market, right? So let's look at what's going on here. We'll do a daily 3 p.m. and we'll go like this. Sorry, I know that I'm trying to kind of move. Let's do an hour. Try to move this so you can kind of see what I'm talking about here. So, okay, now we have a underlying market. It's trading inside the call spread range, and it is probably, let me click through these. So it's trading inside all of these ranges, right? Or at least it's trading inside the two top ones. And another thing with the call spreads that I didn't mention earlier, generally how we do these call spreads is you'll have three that are sort of tighter ranges, right? So this is one of the tight ranges. This is tight range number 2. This is tight range number 3. And then you'll have one that's a lot larger range that allows you to pay sort of more to get in. You have more room to go on the upward and downward. But just looking at, let's just look at these two, because these are both inside this floor ceiling level, right? So you might be saying, okay, yeah, the other one, they weren't all in the floor ceiling level, so it makes sense that they're not priced the same. These are in the same floor ceiling level, and actually these are priced near the same. So this is actually also not a good example of this. I'm really trying here to show y'all a good example of what I'm talking about. Okay, here we go. So again, this is a little bit tighter, but you can see here that these aren't priced the same, right? And the reason these aren't priced the same is because as you get closer to the ceiling levels and to the floor levels, the pricing starts to move away from that one-to-one on the underlying market with the call spreads. And because the reason it's doing this is because you have this optionality baked in, right? You sort of have the time to be right. If I get into this contract right now, it doesn't expire for another 2 hours and 9 minutes, and it will never expire, even if it goes up here. So we were talking about how on the knockout contracts, you really wouldn't want to get into a buy side contract here, right? Because if it goes up here, you're knocked out. You only have a little bit of profit room to make, and if it goes all the way down, you have a lot more losses that you can potentially incur. Similar thing is true for the knockout, for the call spreads. However, what will happen? So if I get into, let's say I get into a sell side contract right here, right? Which actually looks pretty good, right? So if it goes all the way down here, I have a lot of profit to sort of run, and we have a very similar to what we were talking about earlier, where there's the different ticks, right? So we have 139.34 minus 130. We'll do this 0.6. Oops, that's the ceiling of the contract. We'll do 138.6 just to show what we're looking at here. So if we do 138.6 minus 137.6, right, we would be actually right, that would be right in the middle of this. And so it'd be, 100 go up, 100 go down. But let's get back to this price point here. So if I actually get in here, right, this is trading at 0.41, I can actually get in at the sell side. The reason this is happening is basically I'm getting a better price because I'm getting kind of a worse price than what's trading one-to-one with the market, right? Because I have to pay 0.34, the market's actually trading at 0.4. So I want to be paying kind of a higher price for the sell side because I want it to move in a downward direction. So basically the reason this is happening is because if this moves up here, doesn't matter. I'm still in the contract, right? I still have the time to be right. So maybe what happens in the next 2 hours is this market moves up here. If I was in a knockout contract, I'd be knocked out. I'd be out of the trade. My losses would be locked in. Because I'm in a call spread contract, I'm basically paying this optionality, this premium concept, because it can move up here and then maybe it comes back down and comes in my favor, right? So I'm sort of, you can think of the premium and the kind of optionality of the contract as kind of buying the time to be correct. If that, it's kind of one way to think about it. There are some other things that go into this, essentially because the volatility of the underlying market also also comes into play with this. But very generally, as you get to the edges of the call spread contracts, right? If a call spread contract's trading right in the middle, you're going to see the midpoint be a lot closer, right? So, this contract's trading at 1.39 and 1.42. The midpoint of that is right around where the underlying market is. So when the call spreads are right in the middle of the contract, it's going to be trading right where that underlying market is generally. And as it moves to the floor and the ceiling, your prices are going to start getting wonkier, right? The prices are going to start moving kind of in and away from where that underlying market's actually trading. I hope that does make sense. We can actually put on a trade here. Let's put on a knockout trade. So let's get in. And actually, we can see here, one of my knockouts knocked out. I'm pretty sure I was a loss. Yeah, I'm positive. So I lost some money on our earlier knockout, but we can see it's no longer here, right? I had 2 knockouts earlier. Now I just have the one that I'm actually profiting on fairly heavily. And so it looks like we can go back and look at it in a second. But you'll also notice with the call spreads, we have our euro yen call spread, and it's going to be very similar to what we were talking about with the average price with the current price, right? We can go look at our knockouts here again really quickly, and we can see, okay, hey, there's still 4 knockouts. However, there's still 4 knockouts. However, this is I think this one is the brand new one. Yep. So this one was just listed because the one we were in earlier, our buy side knockout, that would have been sort of up here. That was above this, it got knocked out, and then this new one got listed. So this big old red candle, it went against our buy side one, but hey, we're still running on the sell side, right? We have our 94, and let's say I just want to get out of this. You can actually use this close button right here. You can say close, and I can actually get out at wherever I want to. And again, it's going to sort of give you, it's going to close you out at the best available market price, and it's kind of giving you the calculation here, right? Because if we do current market price, we do subtract the average market price from the current market price because we're on the sell side, we get about $98. Let's say I just want to take my profit here, close position, we got out, I just made about $100 on that contract, right? So that is very functionally how the knockouts work and how those call spreads work. I know we did get into a little bit deeper concepts in this in terms of that sort of call spread premium, that call spread optionality, but I do think it's important to understand because I have heard a lot of questions over the years of why are the knockouts trading like this right around where the underlying market's trading, and why are the call spreads to the same exact underlying market, trading a lot different. And actually it looks like basically all of them are trading at no bid because the markets are dropping to the floor right now. Looks like all the U.S. markets are having a pretty red, bloody day. So hope everyone out there is staying safe in their trades. That's really everything I wanted to go over in this webinar here today. If you do have any questions, please put them in the chat. I'm going to throw up, I'm going to throw a slide back on here while we do this. All right, let's. Okay, we'll get to the end here. We'll go all through our nice contract or our nice slideshow here. Oh, let's go back. There we go. Okay. So if you do have any questions, throw them in the chat now. I will take some time here at the end to answer them. Any questions about knockouts, call spreads, or really anything on the exchange. While I am waiting for anyone to throw any questions into the chat, I will put this on the screen here. This is the really best way to contact us. So if you do have any questions, after this webinar, or if you're just watching this in the future on our YouTube channel and you have any questions about anything I said on this, go ahead, hit us up, customerservice@nadex.com. Going to be the best way to go ahead and contact us. You can also hit us up on the website, live chat. If you go to the contacts us page on the live chat part of our website, you can contact us there as well. And that's probably going to be the fastest way to get a response. But if you have maybe a more long form question, the email is going to be better. If you are liking what's going on Nadex, if you like this webinar, if you like just whatever, go to Trustpilot, leave us a review. It helps us out. Our social media teams always want me to remind everyone to go do that. And then we have all our socials at the bottom here. So Nadex, Twitter, Facebook, Instagram, YouTube, LinkedIn. We're on all the big ones. This webinar will be up on our YouTube channel in about an hour or 2 hours. Our YouTube channel also has all the webinars that I do. I do a webinar every Thursday. So if you like hearing me ramble on for an hour straight, go ahead, watch some of our old webinars. I also, as I said, I do them every Thursday. So check back in the next few weeks. I think next week is the platform webinar, if I'm not mistaken. So I just go kind of a deep dive into how to use all the functionality of the platform, some of the sort of more hidden functionality as well. Yeah, our YouTube has a lot of other videos, a lot of short-term videos as well. So check it out. And that's really going to be the end. So I'll give one more second here for any more questions to come in. We have a quiet chat today. That's all right. Quiet's good. Quiet lets me know that hopefully everything's being understood and everyone's taking up all the information. All right. Well, I'm not sure that we're getting any more questions in. We do have one great info. I'll be looking over the webinar again to ensure I didn't miss anything. Thank you. Oh, thank you. I love the nice messages I get. I really do like doing these webinars and talking to everyone about this stuff. So I do appreciate any of the good feedback. And if you have bad feedback too, let me know. Throw it in the platform feedback. I read it every day. So you can tell me I stink as well. It won't hurt my feelings. All right, I think that's going to be not seeing any more questions, so we're going to call it there today. Thank all of you for coming, hanging out for the last hour, listening to me ramble on for an hour straight about call spread and knockout contracts. I know looks like a lot of the U.S. markets are fairly red today, so make sure you're staying safe with all your trades. Make sure you're staying safe with the world in general as things get fully back to normal. And best of luck in everyone's trading. Have a great rest of your day, y'all.